Today we'll be looking at three specific topics. First, we're going to compare the current market comeback to a period not too far in the past, which led to many months of uptrending action. We're also going to discuss how important it is right now to focus on the short-term pattern work. And at the end, we're going to break down the VIX from a different perspective to get an idea of how long this highly volatile trading environment will be with us. No matter how we look at it, it's bear market price action. And all we have to do is look at the table that we track this every day on to give us a very good idea. Just looking at the number of boxes that are dark blue or dark red tells us it's extreme. Through Monday, April 14th, we've had 5 straight days of at least 1% moves. And as we know, a lot of those were much, much greater than that, both on the upside and downside. In the month of April now, we've had 7 1% moves in 10 trading days. So 70% rate is extremely high if it were to continue. As a reminder, in 2022, there were nearly 55% of the days with a 1% move. So a lot, but considerably lower than the pace we've had right now. And so if this were to continue through the month of April, it would be between 14 and 15, which again is more than anything we saw in 2022. So this tells us that we have to be careful. And as we know, what constitutes uptrends? Well, we know low volatility does, and that is because that helps bullish patterns work. We need clean breakouts. Clean breakouts only happen without having whipsaws. We've had nothing but whipsaws over the last 2 weeks. And one way to really look at this is to zoom in on the price action from April 7th to April 11th last week, which was the height of it. Remember, we're coming off of those 2 straight losses of at least 4%. The prior Thursday and Friday came into the day on Monday, April 7th, gapping down another 5%. So if we were to add all those moves up from last week of at least 3%, both up and down, we get a total net percent move of nearly 64%. So if you timed every one of those right, you'd have had a great year within 5 days. Of course, that was impossible. And so while we don't see this in bull markets, we do see this in bear markets. And it tells us within bear markets, it gives us a lot of trading opportunities if it continues to work this way. We reviewed in the past how we had numerous failed MACD sell signals on the way up from 2023 to 2024. But on the downside in 2022, both MACD sell signals and buy signals worked because it was catching those bear market rallies and, of course, the reversals that came after that. So let's understand the environment that we're in first and see where we can work with that. So, of course, all of this has been happening under a very clear resistance area, starting with 5,500. Crystal clear from all of us at this stage, and understanding the fact that we had to rally, say, 13 to 14%, again, to get even back up there. What does this look like right now? It looks like a classic bear sit-up. Had that rubber band that was really stretched, snapped back, and now it's pulled in the opposite direction. So that pendulum has been from one extreme to the other. Because of that, you're staring right up at resistance, right in the thick of earnings season. It makes it difficult to make a bullish call if you look at it just from this perspective. Now, again, how did this happen? 21% move from the low using intraday data and a 13.5% advance, with the bulk of that we know coming when the 90-day hold on tariffs was announced. So very strong move from the lows, rallying back in to a very key supply zone that really everyone sees. Almost seems impossible to make it through this without at least a pause. So when that happens, what should we do? Let's go back in history to see if we can find another time period like this that actually worked out. Well, 2018, 2019, and remember, we and others have been talking about how 2025 is similar to 2018. Because last time tariffs went into effect, that came after a very calm period from 2017, and we just had many months of volatile action, starting with the vol implosion, as we know, at the beginning of the year, and then culminating with an even bigger downturn in the fourth quarter. In fact, it's very similar to now, 20% down in a number of weeks, not quite as quick as this time, but pretty quick, and especially when a lot of it came in December, and then that snapback rally after that December 26th 5% intraday positive reversal led to an 11% gain right from the low as well. And that happened to get us right back to a very key resistance zone, 2600, that again is very similar to 5500 now. And you think about this setup, right? Coming after, again, one of the most historically calm uptrends in history, met by an intense amount of volatility. So when you had the snapback rally right after it, there was a lot of short covering, in addition to traders just looking for a good entry point after a big downturn in a very short amount of time, put us in this area where, again, it looked like a classic bear setup. And I remember at the time, did not feel good staring up at 2600 after all that. And there was not much confidence that we'd be able to get through that relatively unscathed. And if we put both of these periods side by side, it looks even more similar, right? Huge area, broke down from, finally rallied back up to it. Looks like a brick wall at this point. Very similar to right now, especially what's been going on in the news. Not many people want to initiate longs. And really, why would you at this point, right? Up so much from the lows, especially in individual stocks. So what do we need to do? Well, let's zoom in. So we looked at 5,500 on a daily chart. This is what it looks like on a 2-hour chart. If you recall, it was one of the 3 bearish pattern breakdown zones that we had profiled on the way down. We're right back to it, right? And we saw in the past, when we were coming back up from 2023, 2024, those bullish breakouts work. Sometimes there were pullbacks, but most of those times, the previous bullish pattern breakout zones were not violated. So even though we already hit a downside target on this, not being able to get back through 5,500 or the former neckline from bearish pattern, of course, would be bearish as well. And people see this, and you see it much more clearly here on the short-term work. And so underneath the surface, what's been forming? We talked about this one last time. There is a potential cup and handle pattern in play. Again, very short term. This is now on a 60-minute chart, but because of the preceding decline and the comeback, which have been so strong, this is actually a very big pattern. If it were to break out, it would target much, much higher prices. So going back to 2018, 2019, again, this is now a 60-minute chart that we just looked at. This was the December 26th huge positive reversal. Into 2019, again, doubt that we can get much further above that, but what did we see develop? A cup and handle pattern, very similar to what's been in the process of forming right now. Higher low as the year began, and then a breakout, which had some follow through right away. When that follow through actually happened, what did the price action do? It became less volatile. The ranges went from being extremely wide to narrow, much more consistent, with hardly any dips along the way. And so, the doubters at the time were just saying, well, it's just a matter of time. You can tell that demand really isn't there. Look how slow it is. But as we know, boring price action is obviously bullish. And so what did that do? Well, this is that same pattern here, which again, you can't really see if we're just looking at the daily work, but that set the stage for an uptrend, which then continued, of course, until the COVID crash. And as we know, it wasn't a straight shot higher. There were some strong pullbacks along the way in May and again in August, but because the market was able to leverage this bullish pattern, all of these became viable dips along the way because there's now this uptrend had been established. And again, last time we talked about how we saw a similar looking short-term bullish pattern form in 2020, happening again now in 2019. Could it be occurring once more in 2025? We didn't know then, we don't know now, but we had to continue to pay attention to those short-term formations just in case something unlikely is about to happen, meaning that we'll go through 5,500 and not look back. And so I want to touch on a few studies as well. The S&P was just up 5% after declining 9%. So this is just another example of something that shows an extreme move and how typically leads to much higher prices down the road, 1 year, 3 years, 5 years, which is true. Now, big moves like this typically happen when? In response to big down moves. And you can tell each one of these in the past occurred after a preceding downturn of sometimes much bigger magnitude. Now, some of them happen right on the lows, right? October 2023, COVID, of course, and right near the period in 2018 we just talked about. But as we know, they also happened in the midst of some of the biggest bear markets we've seen. 2022, many times before the low was actually in. But the initial downturn we saw in August 2011 lasted all the way until the end of the year before there was some confidence that things would change. And guess what? That's when the big moves stopped and a more trustworthy uptrend started to occur. And as we know, many big moves in both directions in 2008, 2009. So we know typically this is going to eventually lead to an uptrend, to bullish patterns working, to new all-time highs. But the path to get there is what we don't know, and which is why we focus on a short-term pattern work as well. And it's the same thing with the death cross, which of course we know that is happening now with the S&P 500. And so, from my perspective, again, I've seen so many studies on this over the last few days, but this is what it looks like going back 30 years, where the ones we care about most are the dark red lines, which signify the times when the 50-day in green crossing the 200-day in red led to much bigger and much longer downturns. Remember, the S&P 500 didn't top in March 2000. NASDAQ did. The S&P continued further along until finally giving way, and we know that lasted for another few years. The 50-day crossed the 200-day in December 2007. So the market was already starting to roll over a bit. Things really got bad, of course, as the 50 was already under the 200, and then finally didn't get back above it until, as we can tell here, in middle of 2010. And then the last time, as we've heard over the last few days, it occurred was in March 2022, right in the middle of the bear market right now. And so with it occurring in April right now, when seasonality tends to turn a little bit, we're getting a lot of potential chatter about, this being a fake out as well. And we'll see, if the S&P can negotiate at 5,500 level, if it can take advantage of those short-term bullish patterns, this could be another head fake. The main point about all of these studies, keep everything in the back of our minds, focus on what's in front of us, and the technicals first, especially the price patterns. So looking at the VIX, we put on the 40-week moving average on this weekly chart. As we know, that's very close to 200-day. But what this shows us that at the times when the market was most volatile, as we know, the VIX was rallying. But you can tell that it wasn't just a one-day event, even though the spikes show that most of the time. Whereas in 2018, for instance, when we had that vol implosion, we had elevated volatility and elevated risk for the S&P 500 for a few weeks after that. And that's when the VIX kind of stayed above, say, the 15-20 area and found a low right above or near the 40-week moving average. Saw it again later in the year, the period we just talked about, in the fourth quarter, where it stayed elevated, but again, most of the time stayed above that moving average. We know from COVID, even though we reversed very quickly, we still weren't out of the woods yet for a number of weeks. Go to 2022, even starting in late 2021, that's when it started to spend more time above the 50-week moving average, and the times that it pulled back momentarily and got right back above it once more. And that brings us to the current environment. And as you can tell here, after that big spike in the VIX in August 2024, the market continued to rally from that point. But the VIX stayed relatively elevated, which showed us that things felt a little bit different than what happened from before the low 2023, right in October here. Most recently, as we know, it's been staying in the 20s, 30s, 40s. We don't expect the VIX to stay that elevated. We care more about what it does on the way down. Will it respect the moving average? Will it undercut it and start looking like 2021 once more? Because when you have an elevated VIX, when you have all those big 1% moves, it just makes for a very trying equity environment. So now that we know what to look for the VIX, you're going to want to know why high volatility periods eventually lead to the biggest bullish patterns. Because if you don't recognize that, then there's a chance you're going to miss the turn. Fortunately, we made this video about that, what you'll want to check out next.